Coach Matt, I'm kind of new to this whole trading thing, and
Yep.
watching this market go up and downs. Yeah, it's making my head spin. What do you make of all
Little,
this up and
little,
down?
little crazy volatile.
Yes, sir.
I've made the statement in the last few months here, Cam, that if you've never traded in something that does this, right? Everybody's a genius, Cam, when the market goes up. Everybody is. Everybody's coming out of the woodworks. Everybody's a genius. Everybody has their opinions. It's just buy. It's party like it's 1999, right? And when this volatility hits and smacks people in the face, if they haven't been trading for years and years and years and investing for years and years and years, then they don't know how to respond to it, and the fear just kind of drives and the fear happens, and it's almost like, Cam, there's this vicious cycle that happens that the consumers in around the world, they're not traders, they're not financially educated in that capacity, and a lot of times, Cam, they lose out on so much opportunity because it takes them so many years to get back into the market after a market crash that once they get back into it, it's just doing this number again, Cam, right?
Mm-hmm.
That's all it's doing. And so they come into it, and then they come into it at the tail end of a market cycle, and the tail end of when it starts getting a little tougher out there in the market, and all of a sudden the market drives down. They don't have the thirst for the risk. They come out of the woodworks, and now they're saying, instead of saying buy, they say things like, oh, it's a rigged market and Trump's to blame, and no, the Democrats are to blame, or Russia's to blame, or no, when the truth is you're to blame. That's the truth. And so and a lot of these people, they've never seen this because they weren't trading in 2011 when the European debt crisis hit and the market went down 20%, not 10%. They weren't trading in 08, 09. They weren't trading in the 2000s. They only remember those through a dot in time to a certain extent. But the reality is this is something we see quite a bit. And that's what I want to talk about. I mean, because, Cam, if you were trading, say, crude oil, right?
Mm-hmm.
If you were trading crude oil, let's go back in time just a little bit. So I kind of show you this because it's time that people have a little bit of perspective here, Cam.
Mm-hmm.
So if we go back in time, right, and you see crude oil just going up, right? Not exactly as consistent as the market, but once crude oil starts turning, look at that drive to the bottom.
Oh
I
boy.
mean, it just got absolutely smoked over the course of an entire year and a half, to the point where, Cam, it went all the way down to 26, which was about a 75 to 80% drop in price. So where people are freaking out about the market right now, Cam, other traders out there, they're not. Other traders aren't there, and it's not because they traded the bear market of '08, or they traded the dot-com market of 2000, or they were one of those ones that survived the '87 crisis of in what happened when the market dropped 23%. It's the fact that there's always a bear market somewhere. There's always a bear market in. So, for example, if you're just trading the euro slash, US dollar pair here,
Mm-hmm.
okay, and let me put that right, EUR slash USD. Okay, so if you're trading the euro dollar pair right here, you're saying, oh, nice little bull market for the euro. No, that's very consistent. Well, what that means is the dollar's in a bear market, is what that means. Okay, so if the euro's coming up, then that obviously means the inverted relationship to the dollar is going down. There's always a bear market somewhere, always. And so if all you know is I have my 401k and it's a long-term investment retirement account and all that jazz, then yes, looking at what's happening in the S&P 500 right now, looking what's happening in the Nasdaq, looking what's happening in the Russell 2000 and the Dow Jones, and it might be a little daunting, especially in comparison, Cam, to the Twitterverse, right?
Mm-hmm.
Going insane with the political news, economic news, geopolitical news, Facebook corporate breach news. I mean, it's becoming something that is bigger than really what it should be. because the whole world is now getting involved into it, right?
Mm-hmm.
Versus in a normal environment like 2010, 2012, 2013, 2014, 2015, 2016, 2017, when the S&P was just going up, everybody was just reining in on that buy party, right? But the traders and bears have been made fun of for a long time in the marketplace. Oh, the bears calling for another top, and it's like you just show your ignorance when you say things like that, because those bears aren't going to sit there and buy the S&P 500 when the market's going up. They're going to go over to crude oil. They're going to go to the currency market. They're going to go to a stock that's going down. They're going to go do their trading skill set, because
Mm-hmm.
there's always a market that's going up and there's always a market that is going down. And you just have to find it. And so whereas a lot of people are going crazy, the traders like, yeah, this is a little nuts. I get it. But at the same time, they're not going to freak out over a 10% drop in price. And they're not going to freak out because they have a skill set that others don't possess, because they have experience not in trading the market cycle, Cam, but in trading bear markets and trading bull markets and trading currency and trading commodities. And they've seen these things before. And so they try to make the right decision in the right capacity. And what I'm looking at in the S&P with that skill set in mind, what I'm looking at here, Cam, is you see this blue line, Cam, right
Yeah, I
here?
was just about to ask, what moving average
Yeah,
is that?
that is the 200-day simple moving average.
Oh.
And the 200-day simple moving average, Cam, and I've always kind of, I was teaching my son this a long time ago, but it was just a few years, but it was a long time ago in terms of how we think about life. And I was teaching him what the 200-day moving average, and I'm kind of a history guy. I like history and political history, economic history, um, just history in general. And when I was in college, I studied a lot of history, and studied a lot of World War I, World War II, stuff like that. And Cam, in World War I, it was all trench warfare, fighting over this line in the sand, right? That the French and Germans just drew, and they said, "Here's the line in the sand, and we're going to fight for this 1 mile line in the sand." And the Germans, we'll call the Germans the bulls and the French the bears, and the Germans have this line in the sand, and the French have this line in the sand, and they're fighting for this just really small stretch of land, right?
Mm-hmm.
That's what that 200-day moving average is. It is trench warfare for the bulls and the bears is what it is. And as you can see, when the S&P has dropped, look at the volatility here,
Mm-hmm.
and then it double bottoms right on that 200-day moving average. And then look as it's driving down here, and it drives on that 200-day moving average. Now, Cam, the news cycle last week was basically interest rate hikes, right? We saw a quarter point hike on the interest rate last Wednesday. That was par for the course. That did not have an impact on the market, in my estimation.
Mm-hmm.
We widely knew what they were going to do. But obviously the news that came out last Thursday and Friday was quite devastating for the market, that China was going to put $3 billion on tariffs, which was sparking the thought that we were going to get this massive trade war, right? And you saw boom, 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 gets hit, knocked down, right? The French, the bears, boom, 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 they're charging, they get attacked, they go boom, 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 it knocks it down. But you know what, Cam? That's just the headline.
Yeah.
A lot of this is done through algorithms. They don't care about the headlines. And at that 200-day, and I made this statement last Thursday. I was teaching for Legacy Education in Chicago, and I made that statement on Thursday as I was teaching. You watch this. You watch this market hit that 200-day moving average and bounce right back up. And in the news, you'll see the news. Okay, and what the news will be like is something along, it wasn't as bad as we thought type news. And that's
Mm-hmm.
what we got today, Cam. We got the market responding off the 200-day moving average. We got the headlines that, well, China and the U.S. are going to negotiate. Well, no shit, Sherlock Holmes. Okay, yeah, the number one economy and the number two economy in the world are going to negotiate. Yes, that's a $3 billion tariff is nothing, Cam. It's nothing. It literally is nothing. And I know that's weird. It's $3 billion, but it's this technical setup. Now the question becomes, can this be sustained, right?
Mm-hmm.
And that we do not know.
Could I pose a question to you?
Yeah, go ahead.
If we break underneath that 200-day moving average, does it look out below, or
Yeah, it is. It is. I mean, you do have other areas of support, and I'm going to drop this out of the daily chart. I'm going to look at it on a weekly chart. So don't worry about my lines here. It's a little different. But Cam, if you break under this technical situation here, you really don't have any support until 2400, right?
Yeah.
Then after that, you don't have any support then all the way down here to like that 2100 area. And at that point, Cam, you're talking about a bear market.
Yes, sir.
Is what you're talking about, because technically off the highs, you're down over 20%, and that is a bear market. So we are on the, I don't want to say precipice. I don't want to say that word because I don't think that's an accurate word. But we are seeing the beginnings of something happening that could trigger something more. And although I'm not prepared to sit there and say, oh, the bear market is here, the bear market is here, I will tell you, if we do get a close under the 200-day moving average, it is bear time. The bears are not hibernating any longer. They are out there in full force, and they are waiting to pounce. And it's like, I kind of felt like this with Facebook today. Apple came out and basically threw a lot of shade. Let's just say they threw a lot of shade at old Facebook over the weekend, and rightly so. Facebook has violated the public's trust, and I think Facebook's going to go down even more. Right? It might fluctuate up and down based on the short sellers covering the short trade. But I do believe Facebook goes down even longer than this, because you don't breach the public's trust and then just regain it the next day, especially when you give silly interviews, Mark Zuckerberg. But Apple comes out there and just starts pouncing on them, right? They just start pouncing on them. Basically, Apple, and it was Tim Cook, it was the CEO at some Asian technology conference in Hong Kong, I believe, and he was basically just saying, well, Apple doesn't do this. Apple doesn't deal in national in white supremacy, and Apple doesn't give a voice to that. Facebook does, and Apple doesn't breach the public's trust. Facebook does, and I'm thinking, yeah, Apple's pretty secure, but I believe Apple's been hacked before. But the reality is, they smelt blood in the water. These other tech companies like Apple, Google, Twitter, they smell blood in the water with Facebook, and they're going to pounce. That's what they're going to do. The bears, in the same capacity here, the bears coming back to the S&P 500, they smell blood in the water. They do. They smell blood in the water, and they're pouncing. And whether or not they survive, whether or not the bulls survive this, a lot of that will have to do with the 200-day moving average. If it closes underneath, we could see a free fall. We could. And guys, I'm not talking about a free fall in the sense that it goes down 30% in a month, right? You could see more price depreciation. That's a better word for it. But at this point, Cam, I bought today.
Yeah.
I'm a buyer today, because I don't have to pick the side, Cam. I don't have to pick the bull versus the bear. I can wait to see who's winning that battle. I'm not a fighter in the battle of the bulls and the bears, Cam. Yeah. I have a sniper rifle, and I'm up on the hill, and I'm waiting to see who wins that battle, right? So in terms of this, I'm a buyer right now, and as long as that 200-day moving average holds, I'm still a buyer right now, right? I'm looking to acquire more shares of the companies I like. US Steel got just absolutely pounced, Cam, last week, because of a lot of these trademarks, trade discussions, all that jazz. I'm looking to buy more US Steel right here. I'm looking to get more into that. I see this as a buy zone. And you know what, Cam? I bought more right here. And I will buy more right here. And I will cover it the entire way down until I feel like this is turning into something more. And you know what? If I'm wrong on that projection, I'm wrong on that projection. But I don't have to be right to be successful every single time, because unlike some investors out there who just buy and hold and have to be right, we're traders. We'll flip on a dime. We're a speedboat, not the Titanic. So that's kind of what I'm looking at in the S&P 500 right now. When you're looking at your pure support versus your pure resistance zones, your support right here at 2590 is that 200-day moving average. You do have a slight support level right here at 2530 as well. That one, so if the 200 does break, look for a potential bounce at 25.35, 25.30, in that range where you got the double bottom on the ES contract in the futures market. That's a target there. Up above resistance, it's really, really difficult right now. I think you have to target 2,700 and ultimately 2,800. That's where, and I know those are significant whole numbers. They're support and resistance for a reason. They trigger psychological numbers in us, but I'm looking at 2,700 as well. Now, if you're looking intraday very quickly, if you're looking at intraday, Cam, look at the market kind of breaking out of this old resistance zone. You might see some buying coming into that. Okay, coming into those levels. The next one I do want to look at here, though, Cam, is the volatility index, otherwise known as the VIX. The VIX is, for those of you who are new, the VIX is just an indicator that, the VIX is just an indicator that we utilize and look at to help us understand volatility. Volatility is on the rise. The VIX goes up when the markets go down. It goes down when the markets go up. And there's, if you've been listening to the podcast in the last month, guys, same analysis. You're hitting your head at resistance at 25. Look for the VIX to come down, market to go back up. But I do want to throw one thing into this here, Cam, and this is the Archipelago AR high versus AR low. This is one of Gino Por's favorite indicators. And with the market sitting at support, with the VIX hitting resistance, you might want to go out there and buy. But remember what Gino says in the coaches shows. Okay, just because you got a support bounce doesn't mean it comes down. So what Gino would say is wait for it to close above the 50 level 2 consecutive days before you go aggressively. So you can kind of take that shot in the dark off the support bounce, Cam. But if you're waiting for a good confirmation signal, wait for the AR high, AR low to get up above 50. That means the vast mass majority of companies are closing at all-time highs, right? So in terms of this, if you want just a little bit of added confirmation, add the AR high, AR low to your indicator list, and that will help you get higher confirmation in terms of whether or not you need to buy or not. Cam, looking at next is the black gold. Crude oil. Crude oil is hitting its head at resistance. We had it as a symmetrical triangle buy out of the symmetrical triangle last week. I thought the best way to play that was naked puts or credit spreads on the downside. And, Cam, it hit max net liquidation value a week later. It's a max profitable trade. I think that's time to pull that trade off and then reassess. I think we're sitting at resistance. I think resistance will hold for this week. But if you are looking to buy above resistance, well, it's 666 across the board here.
Be careful.
So be careful what you wish for in a breakout of the devil. But in terms of this, if you are looking to be a buyer, aggressive buyer, I think a close above 67 is where you're looking at. Is above 67. I don't see a reason anybody would short crude oil right now unless they just like pain. And there are some people like that. But if you're looking to be a buyer here, somewhere above that 67 mark is where technically you would be accurate in that capacity. The next one here we got is our commodities in gold and silver. Last week we talked about the double, triple bottom on gold. Obviously Trading Justice is big believers in commodity ownership. We love things with intrinsic value. Intrinsic things like gold doesn't go to zero. Facebook is a $500 billion company, and Facebook has lost $100 billion in market cap in the last month. And in 5 years from now, if Facebook was a $50 billion company, I would not be shocked. I don't think that's going to happen, but I would not be shocked. And if in 10 years from now, if they don't fix their data breaches and they keep ripping off consumers and all this, just Facebook might be the precursor to something bigger than Facebook in the future, especially if you start seeing, Congress come out with regulations on these types of data breaches in Facebook. So Facebook has the ability to go to zero. It does. I don't think it's going to happen, right? It's a massive, massive, massive company. But you know what, Cam? So was Enron at one point, and so was Tyco at one point. And you know what? So was Toys R Us at one point. They just shut doors.
Yes, sir.
So, and in 1980s, you know what, Cam? You bought your appliances at Sears and you shop for your clothes at JCPenney's, and you don't do that any longer. So at some point, any of these companies that we cherish and we love and we utilize, or we hate and we despise and we can't stand, whatever it is, they might go away. Gold never has. That's what intrinsic value is. And that's why Trading Justice supports commodity ownership, is because of intrinsic value. And so we kind of liked it at the support level. I said I'm a buyer above 1,300 and nothing has changed here. I would cherish a breakout of 1365. I would cherish a breakout of 1365. And until that happens, I think we're neutral.
Yes,
So,
sir.
said it last week, we're in some type of neutrality between 1300, 1360. I see no reason to come off that assessment, given what I've seen in the gold market. But obviously, the gold bugs are celebrating some chaos out there in the world. Gives the gold bugs all the reason to thrive. And I just wanted to pull up silver real quick to show you kind of the differences here. Gold is showing more strength than silver. It just is for right now. So for the silver gold bugs, we do like them both, but right now gold has been and should continue to show a little bit more strength than silver. Doesn't mean I don't love them both. You know, kind of like your kids, you love them both. You love them all, right? Got 4 kids, love them all. But sometimes I like others better than the other ones. You know
It's
what I mean?
seasonal.
It is seasonal. That is, it's child raising seasonality. This is true. And last but certainly not least here in the market skyline is Bitcoin. And, you know, we said it last week, it's range bound 6,000 to 12,000. That was insane when we said it last week. It's insane today. And it's the same truth. We're still range bound 6,000 to 12,000. But Bitcoin getting beat up pretty hard today. And understandably so, some very negative news coming out of the Facebook world. Twitter, Facebook, Instagram, and other social media platforms are now not allowing crypto coin ads. And so you know how I was losing my mind in 2017, Cam, with the crypto ads,
Yes,
and how
sir.
all these geniuses were geniuses and they were the new Bitcoin millionaires, and it was driving me nuts. Facebook finally said, you know what? Yeah, they're driving us nuts too. And they're not allowing it anymore. Twitter's the same way, Instagram's the same way. Other social media platforms will follow. And the more people get involved in this stuff, the more you're going to see some bad things come out. So that's what's kind of driving this. Technically, I don't see any changes technically between now and what we were talking about last week. And, you know, it literally could go anywhere from 6,000 to 12,000, and I would not be shocked. Cam Morgan, that's the market skyline for this week. We'll be right back with more from Trading Justice.